Good morning, everybody, distinguished guests, members of the faculty, and students. At the outset, I compliment NISM for organizing this conference and thank them for inviting me to address it. The theme of the conference, that is investor interest and innovative instruments, is quite topical. The year gone by has seen overwhelming participation by retail investors in the Indian securities market. The task before us is to sustain growing investors' interest by maintaining market integrity, simplifying processes, ensuring proper and robust risk management, introducing new products, and increasing awareness. Now, let us begin by talking about increased retail investors' interest in securities market from financial year 2021 onwards. The cumulative number of total demat accounts increased from 41 million at the beginning of financial year 2021 to 55 million by the end of the year, an increase of almost 35%. On an average, about 1.2 million new demat accounts opened per month in financial year 2021 as compared to about 0.42 million per month during the preceding year. The trend gets further accentuated during the current financial year. On an average, 2.45 million demat accounts have been opened per month in the first quarter of this year, that is April to June 2021. Equity cash market turnover increased from 96.6 trillion in financial year 1920 to 164.4 trillion rupees in financial year 2021, an increase of over 70%. The share of individuals turnover increased by about 5 percentage points to 51.4% in financial year 2021 over the previous year. Large share of trades originating from mobile devices, and inter-based trading in the total turnover is another indicator of increased retail participation. The AUM, that is asset under management, under mutual funds, increased from 22.3 trillion rupees at the beginning of financial year 21 to 31.4 trillion rupees at the end of financial year 2021, an increase of 41%. FPI investment in Indian equities was $37 billion during 2021, which is highest during any single financial year. As for the overall resource mobilization through the capital markets, despite being a pandemic-affected year, rupees 10.12 trillion were raised in financial year 2021, surpassing previous year's figures of 9.96 trillion rupees. Prevailing low interest rates and ample liquidity availability aren't the only reasons for this increased investors' interest in securities market in India, though one cannot deny that they are major factors, and any tightening of liquidity or increase in interest rates would impact the market. However, it also needs to be acknowledged that by their very nature, the markets are forward-looking and the present investments take into account future growth prospects. Add to this the regulators' effort in terms of continuous dialogue with stakeholders to bring in required regulatory changes, rationalizing procedures, and maintaining trust in the market. Now I come to the instruments and products in which we feel that investors' interest has particularly picked up recently. First is, of course, IPOs, which everyone is noticing. The maturity of Indian IPO market and its resilience to COVID-19 pandemic is reflected in the quantum of funds raised during financial year 2021. Companies raised 46 billion rupees through IPOs as compared to 21.4 billion rupees in the previous year. In financial year 2022, that's the present current financial year, until June end, companies have already raised 12 billion rupees, and from the number of new filings with SEBI, it is expected that the figures will increase significantly going forward. Along with the robust growth, it is heartening to note that our markets are entering a new era with several new age tech companies preferring to list domestically. Our markets offer an attractive fundraising proposition as any overseas market. Recent filings and public offerings reflect the maturity of a market to accept business model of new age companies which aren't amenable to valuation through conventional metrics of profitability. Successful IPOs of such companies are likely to attract more funds to domestic markets, thus creating a new ecosystem of entrepreneurs and investors. Next, I come to REITs and InvITs. When these products were introduced in Indian markets in 2014, threshold investment amount was kept very high because they were new products and investors in general were not aware of their risk return profile. Gradually, the instruments were made available to a wider class of investors by reducing the allotment and trading lot size. The products have taken off since 2017 and more so in the last 2 years. Out of the total funds raised of around 900 billion rupee by REITs and InvITs together till date, more than 620 billion rupees have been raised after 2019-20. In just around 4 years from the time since the first InvIT was listed, total assets under REITs and InvITs has grown to 3.5 trillion rupees. Next, I come to ESG themed mutual fund schemes. Though there is an increased global interest in such investments, sustainable fund investing in India is still a new concept and may take some time to develop. However, one noticed a spurt in the investments in ESG themed mutual fund schemes in India during financial year 2021. The number of NFOs having ESG theme shot up by 300% during this year, that is 2021, while the amount mobilized shot up by 189% during the same period. As at the end of March 21, the AUM of domestic mutual fund schemes with ESG stood at more than 100 billion rupees. Next is ETFs. ETFs with very low total expense ratio as compared to actively managed mutual fund seems to be lately attracting the domestic investors. The investment through ETFs has witnessed a gradual increase during the last few years. The proportion of ETF AUM to total mutual fund AUM increased from 2% as at end of financial year 15-16 to 9% as at end of financial year 2021. From 1.54 trillion rupees at the beginning of financial year 21, ETF AUM has almost doubled to 2.9 trillion rupees as at end of financial year 2021. I would like to now briefly present some of the recent steps by SEBI to facilitate the development of capital markets and further improve their robustness, thereby attracting more investments. I would first like to talk about the steps taken for improving facilitation, simplification, and rationalization of processes. First one is online KYC. One important technology-enabled innovation in the securities market was allowing online KYC. The recent phenomenal growth of retail investor participation in the market could not have been possible without this non-physical mode of onboarding investors. Next, the steps taken for ease of capital raising. Several policy measures have been taken towards ease of fundraising by listed entities. For instance, eligibility criteria and disclosure requirements for rights issue have been rationalized. For eligible listed companies having stressed assets, pricing norms for preferential allotment have been relaxed and such companies have been exempted from open offer requirements. Cooling off period between two qualified institutional placement issues have been reduced. For issuers making a further public offer, minimum promoters contribution and subsequent lock-in requirements have been relaxed. For large issuers, minimum public offer requirement and timelines for achieving minimum public shareholding have been relaxed. Next, I come to a new concept which has been introduced recently, that is accredited investor concept. While most of the investment avenues are available for all type of investors, some investments such as those under PMS and AIFs are restricted to wealthy investors by prescribing minimum investment thresholds. These investors are expected to be well informed and advised to understand the risks associated with such products. SEBI has decided to issue a new framework of accredited investors meeting the eligibility norms when investing in such products. Such investors will have the flexibility to participate in PMS and AIF products with an investment amount lesser than the mandated minimum investment threshold. This is expected to create a ready pool of investors with higher risk appetite to whom complex products with higher risk could be offered and thus bring more investment in such products. Next, I come to the overall improvements which have been brought in system and in risk management. First, I like to highlight interoperability of clearing corporations. By mandating such interoperability, allowing traders to consolidate trades across multiple exchanges and submit them for clearing and settlement to a clearing corporation of their choice. This is an important development. The benefits include better utilization of resources by market participants, lower margin requirements, and reduced settlement exposures due to netting. Next is upfront margining. Earlier, collection of margins from clients in equity cash segment was discretionary for the broker. In other segments, margin collection from clients, though mandatory, was monitored at end of day basis. As a broker still had to put margin to clearing corporation on real-time basis, there were instances of misuse of client collateral. A step to curb misuse of client collateral and to reduce leverage was to require upfront margin collection from clients. Next is pledge-repledge mechanism. Another measure was change in the way clients use their shares for collateral and for margin purpose. The earlier practice for using securities as collateral by clients required transfer of client securities to broker account. There were several instances of misuse of such securities of inactive clients by brokers to provide margins for proprietary trades or trades of other clients or even for funding other businesses. To protect clients' interests, security collateral system was overhauled and a new pledge-repledge mechanism was implemented. Under this, client securities do not leave client's demat account even when they are pledged or repledged up to the clearing corporation level, thereby eliminating the risk of their misuse. Another initiative taken is the block mechanism. It has been enabled for securities in demat account wherein shares of clients intending to make a sale transaction will be blocked in the demat account in favor of the clearing corporation. Earlier, to get margin exemption for sale transactions through early pay-in, securities had to be transferred to clearing corporation through broker. However, if the securities remained unsold, reversal to client's demat account used to take time and involve costs. The new system would remove these hassles. The last one in this category is the recent decision. In fact, a circular has been issued only 2 days back. This is segregation of client collateral. With a view to strengthening the mechanism of protection of client collateral from misuse and default of brokers, SEBI has recently come out with a framework for segregation and monitoring of collateral at client level. The clearing corporations would specify a reporting mechanism that would provide visibility of client-wise collateral at both the broker and clearing corporation level. Next, I come to an important item in view of the especially increased participation by retail investors, and that is of awareness generation. SEBI introduced a new program called Securities Market Trainers Program, that is SMARTS program, in November 2020, in the middle of the pandemic. This is in addition to the other ongoing programs for awareness generation. Under this initiative, SEBI empanels individuals and organizations who have knowledge, expertise, and interest in the area of securities market to conduct awareness programs for existing and prospective investors. Till date, empaneled SMARTs have conducted more than 660 webinar-based investor awareness programs across 23 states and union territories covering 95 districts. SEBI plans to empanel more SMARTs in coming months. Now, media awareness campaigns. Media campaign was launched a few months back through television, digital, SMS, print, and radio, cautioning investors against unsolicited investment tips. This pan-India campaign, with a potential reach of more than 600 million people, was conducted in 13 leading languages. SEBI will continue to enhance its investor education and awareness initiatives to complement similar efforts of various market infrastructure institutions, mutual funds, etc. Now, briefly coming to some of the important SEBI's ongoing projects or initiatives. The first one is Social Stock Exchange. Creation of Social Stock Exchange is aimed at unlocking private capital for social enterprises. It is a pioneering move to facilitate raising of funds by non-profit organizations by leveraging existing and innovative structures within the securities market domain. It would bring more visibility to the social impact that the social enterprises create. The envisaged ecosystem would comprise of a platform for investors, donors, and non-profit organizations, instruments for fundraising, minimum reporting standards, information repositories, social auditors, and also a capacity building fund. Next, I want to briefly state about Gold Exchange. The Union Budget for financial year 21-22 announced the setting up of Gold Spot Exchange with SEBI as the regulator. The proposed Gold Exchange would provide a new asset class for investors. It is expected to infuse transparency in spot gold transactions and over a period of time enable India to emerge as a global price setter for the commodities. Our next focus is on ETFs. Globally, exchange-traded funds have emerged as popular product and provide liquid exposure to investors on even relatively illiquid underlying assets. SEBI is examining how to increase ETF liquidity on exchange platforms and feasibility of introducing new ETF products such as corporate fund ETFs to increase liquidity in corporate bond market, which is very much need of the day. Then I come to an important issue, that is the need of continuous innovation and research. Innovation is the trait of a competitive financial market structure where the market participants need to continuously innovate to remain relevant. SEBI has introduced regulatory and innovation sandbox frameworks wherein new ideas and products can be tested on pilot basis before implementing them in the market. Even those ideas which failed in sandbox would make us wiser as to what works and what does not. SEBI has continuously endeavored to promote research in capital markets to facilitate analytics projects, research activities, and academic studies on capital markets. A data sharing policy has been put in place. In order to foster data-backed research in Indian securities market, SEBI has constituted two expert standing committees, namely Market Data Advisory Committee to enhance the quality, availability, and access to relevant data, and Research Advisory Committee to guide a strategy to scale up research in Indian securities market. Another research initiative is the Development Research Group Study Series to encourage external experts to contribute to policy making through research. NISM is the educational institution. NISM is the educational initiative of SEBI. I expect it to play an enhanced role in fostering capital market related research and innovation. I also wish that it emerges as the go-to place for SEBI for advice on important policy issues. I express my best wishes for the conference and look forward to constructive and innovative suggestions emerging out of the deliberations. Thank you.